Every major economic collapse in modern history shared one defining characteristic. The people who built generational wealth did not merely react to the crash, they had prepared for it well in advance. For decades, mainstream financial advice has promoted a single narrative: crashes are unpredictable. Diversification is your only protection, and attempting to time the market is dangerous. This story works reasonably well for ordinary investors. It was never designed to serve the ultra-wealthy. The ultra-wealthy follow a different playbook, refined over more than a century. Their strategy begins not when markets collapse, but roughly 18 to 24 months earlier. Here are the 5 assets that consistently appear in their positioning. One is technically available to anyone, yet most people have never heard of its strategic power. The 5th is the primary legal mechanism through which wealth transfers from the middle class to concentrated private capital during every major downturn. Asset 1. Short-duration treasury bills. The first asset sounds deceptively boring, yet in institutional wealth terms, boring often means highly effective. Before the dot-com crash of 2000, the 2008 financial crisis, and the 2020 COVID shock, a clear pattern showed in SEC 13F filings of America's largest investors. They were not buying gold, real estate, or commodities. They were accumulating short-duration U.S. Treasury bills to 90-day government paper, yielding barely more than a savings account. Warren Buffett's Berkshire Hathaway, for instance, held over $130 billion in T-bills in cash, equivalent by mid-2023, ahead of regional banking stress and commercial real estate weakness. The financial press called it overly conservative. In reality, Buffett was quietly loading capital for deployment at the right moment. This highlights a key difference between ultra-high net worth behavior and conventional advice. The wealthy do not treat cash as an opportunity cost. They view it as the only asset that can be converted into any other asset class when prices collapse. During the 2008-2009 crash, the S&P 500 lost about 57% of its value. An investor holding $10 million in T-bills, earning roughly 2%, still earned interest, while others lost half their portfolio and possessed dry powder. To buy high-quality businesses at deep discounts, the Knight Frank Wealth Report noted a sharp rise in liquidity preference among ultra-net worth individuals starting as early as 2006. The popular slogan, "Time in the market beats timing the market," serves retail investors who cannot move large sums discreetly. For those who can, there is no structural barrier to following the same approach. Only cultural conditioning that dismisses it as too simple. Crashes create forced sellers. Forced sellers need buyers. Buyers need cash. The ultra-wealthy accumulate the instrument that survives any crisis, then wait with disciplined patience. Asset 2. Distressed debt. The second asset reveals that every major crisis also functions as a wealth transfer mechanism, flowing in one direction. Distressed debt involves bonds of companies nearing bankruptcy. A bond, ISWID, at 100 cents on the dollar may trade at 15 to 20 cents. As panic spreads, retail investors flee, and media declare the company's dead. This is when sophisticated capital enters. Howard Marks of Oaktree Capital built a major firm on this strategy. In his October 2008 memo, he explained that distressed debt is not merely a gamble on survival. It is a legal route to acquire company assets at a fraction of replacement cost, without paying equity prices. In bankruptcy, creditors follow a strict priority waterfall. Senior secured debt ranks highest. Equity holders usually receive nothing. Distressed bond buyers often emerge as the new owners after restructuring. During 2008-2009, funds bought debt from automotive suppliers, real estate trusts, and retailers. General Growth Properties filed for bankruptcy in 2009 with debt trading at pennies. Brookfield Asset Management accumulated positions and later gained control of the restructured mall operator at low cost. The Capgemini World Wealth Report showed high net worth individuals using alternative credit strategies outperformed diversified portfolios by about 23% in the 3 years after the crisis. Retail investors are largely excluded by high minimums and complexity. The uncomfortable reality is that distressed debt requires economic distress. Each bankruptcy transfers productive assets, factories, real estate, networks, from dispersed shareholders to concentrated private capital at bargain prices. Modern bankruptcy law produces consistently directional outcomes. Asset 3. Productive agricultural land. The third asset is the oldest store of wealth, older than stocks, bonds, or central banks. It has survived every collapse and is being accumulated today at an unprecedented pace. Productive agricultural land. According to the Knight Frank Farmland Index, prime U.S. farmland rose over 500% between 2000 and 2020. It stayed resilient through the dot-com bust, 2008 crisis, and even gained about 7% during the 2020 shock, while other real estate suffered. The reason is simple. Land that produces food has an intrinsic floor based on human caloric needs, regardless of monetary failures. In 2023, Bill Gates was reported as America's largest private farmland owner with approximately 270,000 acres across 18 states. While media often framed this as eccentricity, the logic is ancient. In the Roman Republic, patricians expanded estates by acquiring land from indebted farmers. After the Black Death and during Germany's post-WWI hyperinflation, those with liquidity bought farmland cheaply. In Venezuela's crisis, export-oriented farmland retained value while domestic assets collapsed. Productive land tied to global demand transcends failing currencies. It is not just dirt, it is a biological claim on the future. Asset 4. Blue-chip fine art. Via private treaty sales. 4 to 6 months before major dislocations. Private treaty sales at Sotheby's and Christie's, discrete, relationship-based transactions. Outside public auctions have consistently spiked for decades. Before 2008, private art sales surged in 2006, 2007. The same pattern appeared before the dot-com crash, and in 2019 to 2020. Blue chip art shows near zero correlation with equities. A May Moses study found that top-tier art fell only about 4% during the 57% S&P 500 drop in 2008-2009. The key is fixed supply. Masterpieces by deceased artists cannot be reproduced. When central banks print trillions, assets with permanently limited supply become stores of value. Private treaty deals add opacity. Sellers can accept discounts without public disclosure, and buyers acquire works at favorable terms, not reflected in indices. The Capgemini World Wealth Report notes that investments of passion, including fine art, typically make up 5 to 10% of ultra-high net worth portfolios, often rising before periods of stress. For the wealthy, this is strategic preservation disguised as cultural interest. Asset 5. Essential service, monopoly, businesses. While the first 4 assets focus on preservation and opportunistic transfer, the 5th is offensive. The engine that creates new fortunes during collapses. It lies in unglamorous private equity targets, essential service monopolies. In the 12 to 36 months after every major crisis, private equity systematically acquires businesses with inelastic demand: waste management, self-storage, funeral services, pest control, water, infrastructure, and medical waste. People cannot stop using these services even in downturns. These businesses gain advantage in crises. Revenues remain stable, labor costs fall, and distressed competitors sell assets cheaply. Wayne Huizenga built waste management by acquiring small operators during the 1970s stagflation. He needed no innovation, just roots and trucks that continued operating regardless of economic conditions. PitchBook data shows private equity acquisitions of such businesses rose over 40% above pre-crisis levels between 2009 and 2012. Boring businesses ignored during booms become high-return targets and busts precisely because they never carried speculative premiums. Their cash flows persist while valuations collapse. The larger lesson: every economic crash is not a random disaster. It is a predictable cyclical redistribution of capital, from the unprepared and panicked to the patient and structurally positioned. The middle class is taught that crashes simply happen to them. Data from SEC filings, wealth reports, auction houses, and private markets tell a different story. Crashes function as planned acquisition windows for those who know what to buy, why, and at what price. The financial system has not hidden this through malice, but through the assumption that only insiders can act on it. That assumption is no longer entirely true. The principles are accessible. Cash and T-bills are ammunition. Essential service businesses provide permanent cash flow. Agricultural land offers a caloric claim on the future. Distressed debt is ownership in disguise. Blue chip art delivers non-correlated preservation. None require elite access to understand. They demand only the willingness to observe what those building generational wealth actually do, not what they say publicly. If the next crash is already casting its shadow visible in rising T-bill holdings, quiet farmland acquisitions, private art deals, and distressed debt positions, the question is simple. Where do you want to stand when it fully arrives?